Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by our team of property experts. And joining me today is John Howard, property developer, author, TV panelist, mentor. Can't think what else, John.
It's a tiring list. There's a few more as well, which we won't go into.
Right, okay. Well, we'll just leave it at that.
Leave it at that.
Yeah, right, okay. And joining John is Zee Razaq, CEO of Surtax Accounting, property taxation specialist. Welcome to you, Zee.
Thanks, Stephen. Also not as esteemed as John with his long list. So,
right.
Yeah, good.
Right. Well,
a lot younger though. A lot of time to get that list together. Don't worry.
Yeah, trying to get the wisdom. It's so good.
But I don't know how either of you are qualified. You're not from London either, are you?
No, there's a big wide world out there, Stephen.
Yeah. Where is it you come from, John?
Suffolk.
Suffolk. What happened to Ipswich? Is that in Suffolk?
Yeah, that's in Ipswich. It's only an hour away from London.
Right, really?
Yep.
Listen, I'm from good old Hemel Hempstead, so that's not far.
Okay, all right. Well, we'll give you sort of half citizenship, shall we? Okay, well, let's get straight on with the questioning. And John, you're going first.
Yeah.
Do the panel believe that with shortage of materials, shortage of labour and development costs rising by the minute, requirements for green measures affecting new homes will be abandoned in cost-saving exercises, possibly assisting greatly the first-time buyer?
That's a cheerful question, isn't it, to start with, from someone who obviously sees the future in a less rosy way than the rest of us maybe.
Are you suggesting I have a dismal outlook at the moment?
Well, if you know the person that wrote that one in, yeah, probably. It's very interesting, isn't it? Obviously, with what's happened to energy and so on in the last 12 months, everyone's reevaluating a lot of these green issues and green initiatives. We all want to be green. We all want to do the right thing. Zero carbon or whatever by 2050. My view is that things will speed up very quickly at some point. You know, electric cars is an example where, you know, I think electric cars is a temporary measure. I think that someone will come up with a synthetic fuel probably.
I think hydrogen's the future.
I mean, my electric car coming back from Conservative conference, you know, I'm stuck, can't get the charger to work, pouring with rain. It's okay, but it's not really the answer. And in terms of property, the cost of some of these green initiatives is crazy. It's absolutely crazy. And I think they're going to have to tone them down. I mean, modular is an interesting one in itself, modular buildings, because of course, everyone's raving about modular buildings, but they're still too expensive to build. And until you get the top 10 house builders coming on board with modular, you've got no chance. And they won't come on board at the moment because they're too expensive to build.
But you see, John, we're very stop-go in this country. Look, we've both bought electric cars at times. I've actually sold mine now, but you've got a new electric car. But they're telling me at the dealerships that the sales of electric cars, which absolutely surged 6 months ago, have just fallen off the cliff now because everybody's worried about the cost of electricity.
Well, as soon as I buy one, the electricity prices go through the roof. So I was about smug for about 3 weeks, wasn't I?
Yeah. But I think petrol's looking cheap now.
Petrol's suddenly looking cheap again, and that's the worry they've got. Of course, is if are things going to slide? And actually, you know, if you want to build 300,000 houses a year, which is what the government are targeting, they need to build 500,000 really. But anyway, they're targeting 300. They built 220 last year. 1,000 last year, I think. So, you know, you're not going to get to that target if you fill these houses with every green initiative possible, because they'll be too expensive to build, and the developers won't build them. So there has to be a balance with this, and I think we can catch up. And any time we lose in the next 5 years, I think we can catch up in the next 20 years, if you like, coming up to 2050, because everything is changing so quickly. New ideas coming in all the time. So I don't think. You know, I think it's a very good question. I think the answer is it will hold up development, but I think in the end common sense will prevail.
Yeah, I think you're right. I mean, these ideas. I mean, I've mentioned on this show before. I mean, a development that I was involved in down here, council made us put in biomass boilers as a reserve boiler. I mean, I think from memory there were £1.5 million each. Okay, so there was one for each building. And It was then discovered, of course, that the wood chips for biomass fuel were so inflammable that you couldn't get insurance on the building. Yeah. So the council then, so disjointed, make you do this, make you do that, and then it has no effect.
But ideas change all the time.
It was just 3
minutes. You've got, all the time, there's new ideas coming forward, and they make the old ideas look silly, probably, but...
Just to add to what John's saying, I look at it slightly different. I think, what is the government, who are they trying to buy, as the incentivizing who they're going to buy the properties? If it's a first time buyer, they've got to look at the cost, because when you go and get a mortgage these days, you're looking at your earnings to mortgage value ratio, right? And as we know what's happening last week, we're not going to mention after why it's happened, but a lot of the products are getting pulled. Right, so now it's not your income to 5 or 4 or 5 times your income that you're getting mortgages. Just drop it. So you've got to look at who's your target market. I think that's really important, because when you start doing green initiatives, you're increasing your base cost of the property, and then you're going to restrict people who actually want to buy the properties. And most of the government keep on going on about giving a stamp duty land tax relief for first-time buyers.
Fantastic, isn't
right?
it? What a great government.
It's a great initiative, right? But the problem is, if the person can't afford to buy the property because the costs are rising of the property, because of materials, labour, the green initiatives.
The converse to that, though, is that they'll be much cheaper to run. That's the one thing. They will be cheaper to run with all these green initiatives in them. So, you've got to balance it, I suppose, but I agree with you, Zee. At the moment, they're going to overprice them for first-time buyers.
The stamp duty tax saving, right, is getting eaten up, because the person's trying to sell it is having to inflate the price. And if I look at the average earnings, it varies depending where you are in the country.
But that's the same thing with going back to the electric car example, isn't it? When they first came out, great, you got no congestion charge in London and all this, cheap parking and all the rest of it, but you're forgetting that the electric car costs you 20 grand more than a petrol one in the first place. So,
there are some tax initiatives there.
Electric cars, like you brought that up. I was seeing the old Tesla, not advertising Tesla, looking at the Tesla, huge incentives still. And if you structure those correctly in limited companies, fantastic tax savings, right? So that's still available from VAT, even if you're using it personal, also corporation tax. And you can incentivize. And if you do it using, for example, hire purchase, you're getting the value in day one, but you're still having a cash flow benefit. So you've got to look at these things, and it can be hugely benefit. Depends on what kind of cars you like.
I think we'll be knocking on his door very shortly. Yeah, bit of advice here, John.
Definitely.
All right. Okay, let's move on. Zee, your first question. I have listened to experts on property question time over the years give conflicting advice on whether a small investor should have his properties in his own name or in that of a limited company. I guess the advice was in the main driven by taxation rules at the time. What do the experts think is the right answer in today's financial climate?
Really good question, and this question comes up so commonly, and I'm sure, John, you probably have loads of people. It depends on your circumstances. Right, and I'm going to be really clear. If you're doing buy-to-lets, let's focus on that. Right, if you're earning, say, 40,000 in your job, and you're getting over 10,000 gross rent, less certain expenses, excluding mortgage costs, you've got a problem, because suddenly you're not getting the relief on mortgage, and you're becoming a higher rate taxpayer. So buying your own name becomes non-viable. But some people have lower incomes, and they maybe could buy one property. Because I think we spoke in a previous episode around the benefits. When you buy something in your own name, you don't have double taxation, and you get an annual exemption for capital gains tax, which is $12,300. Also, if you factor in your wife and other people that you can buy this property, you're spreading the load. So there is some advantages, but if you are a serious property investor and you want to do a buy-to-let and scale it, then it's going to be a limited company, because the tax on interest, the layman's terms, section 24 of the Finance Act, right? So you've got to weigh that up, and that's the key decision make between the two things, and also how you're going to exit. The problem is, if you buy in your own name, another bit people always forget about, and you'll probably say this, John, is there's something called inheritance tax. Bit of a nasty one, right?
Something that I'm sorting out at the moment.
Yeah, we need to have a chat, all right? And the inheritance tax planning is so important. And I talk about, because investment businesses are treated differently to trading businesses. And people got to understand that if I'm a property investor, I'm an investment business. So it's subject everything to my estate. So if I have it in my own name, it's hard to reduce the taxation of inheritance tax, if I'm the ultimate owner. If I put it in a company, and we'll touch later on this, you can set up structures to benefit your legacy and pass that wealth. That's the key.
Okay, good. Well, I think that's a fairly clear answer.
Very clear answer. So, excellent. Yeah, really good.
Anything to add to that, John?
No, I've had a limited company since I was 18 years old, different limited companies. And I think if you're being professional, you want to get into it professionally. And even if, you might do your first one, like you said, in your own name, because the 12,000 a year tax relief and so on you get, once you get into the second or third one, you've probably got to do it in a company, haven't you, basically?
Yeah, and I think the other thing is the transition. People don't realise you can do transition, but you need to meet certain requirements. You've got to start using partnerships, otherwise you get the dreaded Form 17. And
basically, you need an expert. Again, as we always say, don't we, on this show, whatever it is, find an expert who knows what they're talking about and take their advice.
Okay, on that happy note, we'll go to the break. So that's all we've got time for in this half of the show. Join me again after the break when we'll be asking John and Zee more of your questions. Hi, and welcome back to part 2 of Property Question Time with John Howard and Zee Razaq. So, John, your second question.
Yes.
Right, having read the property press, it seems pretty inevitable that we're heading for a property crash.
Oh dear.
Do the panel concur with my view that during this crash, it would be the most advantageous time to start to buy and build a buy-to-let portfolio? Assuming that there is a reasonably timed recovery, rental return rates should surge, thus benefiting from the potentially low purchase prices. What do you think?
Well,
is it a time to be brave?
Well, the first thing I'd say, I've survived 3 property recessions. So, and I know you have too.
I'm not sure I've survived. That's
the
trouble.
What I would say is, property is normally like a big boat. It takes a long time to stop, turn around and come the other way. We all think a crash is like overnight, there's a crash. If there is a crash overnight, by the way, it bounces back pretty quick. But most of the time, it's a fairly painful decline for a year or two, and then it starts to bounce back. Now, how do you know when it's bouncing back? The auctions, because the auctions are the best barometer for the property market. As soon as the clearance rate at auctions goes down to 50% in a crash, or recession. Once that starts coming back up again, that's the time to buy. New cars start selling again. So once the sales of new cars goes up, fill your boots, get cracking. Should you ever catch a falling knife? No, you shouldn't really, unless you're very skilled in the property world.
Do you know what I think is interesting there, John? You mentioned the sort of car statistics. It's quite useful, that. I mean, I know we had...
Thank you, I use it a lot.
We've had on a previous programme people saying, well, how do you know when it's the bottom of the recession and that? Well, you don't really.
No.
And the trouble is with property data that it's usually about 3 months behind.
You're land registry, 3 months behind, you're spot on.
Whereas the car industry...
is instant.
Well, it's within a week or two at the end of the month, isn't it? Yeah,
that's instant enough for me. Yeah. So all those types of things... I tend to look at those things rather than I do listen to experts, economic experts, the government, the Bank of England. How often are they right? So I tend to look at things that are actually happening rather than the talk of it. If you get my meaning.
Yeah, I do.
And I think the person is absolutely right. Great opportunities. I've made more money coming out of a property recession than at any other time in my careers. I've had 40 odd years, and there's times to be brave and there's times not to be brave. I don't think it's a time to be brave at the moment. It's a time to sit back, have a look, see what's going to happen. As I said, it's a big boat. It takes a long time to stop, turn around and come the other way. So there's no panic, there's no rush with this at all.
Do you see any difference with this, let's just call it a potential recession in the property market? Yeah. Do you see any difference with this one to previous ones, to the 3 that you referred to?
I think they're all different. They're all different, but the outcome's the same. People will go bankrupt, people will lose their homes, and there'll be a lot of unhappiness. And it's the big risk takers that go first, the big risk takers. And in the end, everyone gets into difficulties. Do
you think we've learnt anything from COVID in the way the government, I mean, they were talking on the news this morning, somebody asked, will the government provide any assistance for mortgage holders who get into trouble? Well, I don't think that's feasible.
I don't think that's feasible. I mean, goodness me, you know, it's everything is the government's fault. If you're too fat, it's the government's fault. If you're too thin, it's the government's fault. If you bought a house and the property market goes down, that's their fault. But what they forget is when things go right, it's never the government that have helped that happen. Oh no, it's nothing to do with the government. Things go right. So come on, the government are there to support where necessary. And what a fantastic support they've given in the last few years. Goodness me, energy prices. I mean, the best support in the whole of Europe. You know, come on. I mean, where does it stop? Where do people take responsibility for themselves? Personal responsibility. You know, crazy.
Zee, what do you think?
I look at it slightly differently, and I've got a bit of a banking background, so I understand finances and liquidity. And one of the problems is that people don't understand what the indications the banks are showing, the real indicators. Because if you look at the last financial crisis, liquidity drives up, and that's starting to happen. So in my world, we're already in recession. It doesn't matter what the numbers are telling me. When liquidity gets affected, that is the ultimate issue, because it doesn't, unless you've got a huge amount of cash, which most people won't. You can't go and pay 100%. You still need leverage, right? So you need to do that. So two things I always say to people, be really clued up. One, what strategy? Get investment with John and many others around knowledge of what property strategy you're doing. And number two, seek advice. Because depending on what property strategy that you're doing, the answer changes. Structuring, the financing, because if you're doing commercial, have different rates. And it's going to be higher amount of deposit. If you're doing residential, the rates are different. Right. So you need to look at the banks. It's such a, not what Bank of England are giving FaceTime. I'm talking about how the lenders are lending. Because when they restrict finances, then you know there's opportunities. Because whoever's coming up for renewal, depending where they're in the cycle, they're going to feel it, aren't they? Because they're going to have a higher deposit loan to value ratio, right? They're going to, the deposit is going to have to higher. It's going to probably end up being 40%.
Well, they're going to have to put cash in on renewal, which they perhaps haven't got. And that's what happens with banks. Banks decide to reduce the loan to value on renewal. You haven't got the cash to put in. They take the property off.
And the other challenge is actually financing the cash flow, right? How are you going to pay the repayments? Because what happens is our interest rates are going up. So whoever you speak to really understands the numbers. Cash is either king or queen.
Cash is always king.
Depending
cash is always king.
King or queen, depending who you're speaking to,
be,
right? And that's the difference makers. If your asset cash flows, you'll make the numbers. If you've already put that in your numbers, normally the benchmark was about 5%. I think it has to be about 7-8% now, even up to 10%. And people might be, Zee, you're going a bit high.
You know what?
But if you don't budge that, because next 5 years, you've got to think 5 years.
Well, I can remember sitting in an office listening to it go to 15%.
Yeah. We're a similar age. So yeah, I mean, you know, it's happened in the past, it will happen again, but people have been spoilt. And, you know, I don't want to sound like some dinosaur, but you know, people have been spoilt on incredibly low interest rates. Well, it's just not practical to think they would continue unfeasible forever.
Of course,
you know,
of course.
I think I sort of just had built into me during my business career that you know, and anything under 10% was cheap.
10% was average.
Yeah,
10% used to be average.
Yeah,
absolutely.
And that's how you would cost your business.
And that's what you're saying, Zee. You're saying the same thing.
Huge opportunity.
Building 10%.
Because if you think about it, a bit before my time, early 70s is probably the equivalent of what's happening right now. And why I say that is very rarely in our history, we go and look at the rates of inflation in terms of interest rates. That is the key determination. Sure. When inflation is higher than interest rates, you're making money by holding money. Yeah. But from that interest rate to inflation. Definitely. Zero to interest rate, you make sure cash flow does. So it hasn't happened since the early 70s. No. So people who are smart now are leveraging and borrowing money, because they know they can fix the rate for 5 years and they can use that money when the Christmas sales start happening.
But Zee, I mean, I was again listening to some financial news this morning, and they were saying, well, okay, it's just reduced very slightly at the moment. The expectation on 2-year mortgages for the moment is probably, I think, 5.75% or roughly, they were saying. But they were saying that a 30-year fixed term mortgage, they were being offered around about 4.25%. I mean, are the funders just taking a punt on that figure?
Really good question. I think from a funding perspective, when you look at the institutions, they're in an area that they're not sure about, because this isn't the same as many other recessions, because we've got liquidity, because of bounce backs and all this aspects, and people have overpaid for the last 2 years on property. You know, I speak to so many investors and developers on a daily basis, which I feel privileged, and I get insight, and they've been overpaying because there've been loads of liquidity.
Well,
so when
with
this
due respect to you, they shouldn't have been doing it, then, should they?
What's that?
They shouldn't be doing it. They shouldn't be. They should have kept the.
It depends on
They
what your
should
longer term
have sat on their hands, shouldn't they?
Fair point. It depends on the longer term strategy, John, because some people think longer and they think, look, I'm going to get capital appreciation as long as my cash flow stacks up. Some people like, I've got enough cash, I don't want to leave it in the bank because I'm scared of inflation. It's gain. So why doesn't the bank pay for my inflation? So it's different strategies. You've got to look, but ultimately, have they got a good structure? Have they got a good cash basis? Have they actually understand what's happening with their business? Financial management is so key. It's your, you know, it doesn't matter how good you are and how nice and everything else. If your numbers don't stack up, you ain't got a business. Simple as that.
Very true.
All right, we must move on to your question now, Zee. I'm being asked by my bank to revalue my property portfolio, and I'm guessing that's going to happen a lot in these times, isn't it? Made up of both buy-to-let and HMO properties. I'm guessing that they're nervous about the funding levels in what may be a critical time in terms of concerns about the economy. However, are there any taxation implications if my portfolio has increased in value and I have to show this in my accounts? And in addition, are there any benefits, perhaps in terms of tax credits, if the value has overall gone down?
Great question. Most people who are not probably involved in property don't understand. It's more an accounting rather than a tax issue. Because what happens is under, I'm going to get a bit technical guys, FRS 102, that's the financial reporting standard from an accounting, you're supposed to revalue your properties annually. Most people struggle with that, so you should do that. It's an accounting adjustment. So the value goes through your accounts, but it gets not included in the tax calculation. Okay. So you don't have corporation tax issues. But the thing that you've got to be wary of is something called deferred tax. And people are like, what are you talking about, Zee? Deferred tax is an accounting adjustment, but it restricts what money you can take out. So if you had a lot of reserves, i.e. made money in the past, you just got to be aware of that. You may have slightly less money that you could take out as a dividend, because what deferred tax is doing is looking at what tax you could pay if you sold it, right, and holding a bit back, in simple terms. So there isn't a tax here. The opportunity actually, there is opportunities here, because you mentioned HMOs, household or multiple occupancies,
so
right?
We have to mention HMOs.
We just talk about some of the benefits. So you have community areas, like we've talked about in the office or in the studios. These are considered commercial use. The community areas, you can claim capital allowances, which you can't do in buy-to-lets and residentials. Provided you get that can be offset.
Is that because it's commercial?
It's
considered commercial.
Yeah, but the actual rooms you can't.
So okay, because they're residential.
Exactly.
But the hallways are considered commercial.
The community areas, and that is, if you've got a number of HMOs, that can be beneficial, because if you get a commercial property,
well, it could represent quite a percentage of your area space.
And then structuring becomes
20% of it, probably 25%. Maybe.
Yeah,
staircases.
Yeah, and if you've got elevators and things like this, it depends on what you've got. So getting the right advice and the right specialist, you can see benefits everywhere.
Well, John, comes back to the same thing, doesn't it? Get your professional advice.
I'm sorry to be so boring, but it does, doesn't it? It does.
Okay, well, that's all we've got time for in this show. So, John Howard and Zee Razaq, thank you both very much for coming in.
My pleasure.
Great answers to the questions, really helpful. Thank you both very much indeed. I'm Stephen Galpin. Join me again next time on Property Question Time.